Okay, welcome to today's show, and we are going to talk about bottleneck. And when we look at investment and talk about whether it's the stock market, whether it's property market, everything has that point where it bottlenecks. Jim, we talk a lot in here about finding opportunity, but sometimes an investment is not always about the opportunity. It's about recognizing, where the money is getting trapped in a market, which I suppose in itself, it's an opportunity in itself if you could identify that. And with every market, whether it's property, stocks market, whatever, they all experience, different times where they do bottleneck through the generations. And recent things like interest rates have been a big factor in the property market. But it could sometimes be things like, fear or government policy, which we've spoke a lot in recent shows about as well, having an impact on individual markets. Or possibly sometimes just waiting too long. People do sit on the fence too long, especially property investment, and miss opportunities and miss their time to get in there in that market and make their investment journey start.
This is literally down to critical path analysis.
Yeah.
So let me explain it. It's a project management technique that identifies the longest sequence of dependent tasks required to complete a project. That's all it is. So when you talk about a bottleneck, I immediately think of critical path analysis to resolve that situation. So it's actually identifying that somewhere and what is causing the issue that you can't go any further. Happens time and time again. I always go back to the story I first remember when I started. Was I used to phone up the bank and I used to ask them if I was going to get a loan, 75% or 80% loan to value, what would that entail? How much would I need to earn to get that loan? Because there used to be a criteria on your earning, and they would say, oh, yeah, you've got to at least earn over 25,000. And they went, oh, can I get? And then they would go, can I get your name and your address and that, and I'll get you registered. No, it's okay. I need to go and do something else. So I would now know that 25,000 was the minimum criteria. Remember, this is before you had brokers that knew anything about buy to let. This was before buy to let. It never even existed at that point in time. And then I went to the next stage and I phoned them back again. And obviously you'll get somebody different because you've got a call centre. And then I would ask, I know you've got to earn 25,000 to get this mortgage, but is there any other criteria I need to be aware of in order to qualify for that? And then they would say, oh, this, that, and this and that. And I would go, okay, great stuff. And then they would say, can I get your name and number? And it's like, no, it's okay. I've got to run. I will come back to you though. Thank you very much. And then I would phone back again because I'd know that bit next. And then I would know exactly up to that point. And then I'd go, okay, I've got another bottleneck here. I don't know what comes next after that. So then I would say it again. Now, the reason I did that is because they wouldn't have registered me multiple times and then realised that I was trying to work out how their system worked to tick every box to get the transaction done. So I always used to tell them that my earnings was £25,032.
Why was that?
That's a good question. The reason for that is because my earnings were significantly more than that at that point in time. But if I was to tell them my earnings were significantly important at that point in time, they would then say, prove it. Whereas if I said it's 25,032, they do a credit search, it passes, and they go, yeah, that's okay. Because that's normal. If you say you've got 40 or 50,000 or 60,000, then they go, you have to prove that then. It's like, but I've got more than 25, but we still have to prove it now because you've said it. See how significant deviations from a system has been set up to computer says no if you don't tick these boxes, then highlight and it's an exception reporting system. So what an exception reporting system is, it only spews out stuff to look at if it's beyond the standard deviation. In other words, what they would not expect to happen, then they would actually look into it. I've got to say it's classic when you put a tax return in or you put your accounts in. It's like, if you've got something which is significantly more than the year before, they're going to ask questions why. So that gives you an insight into how you should look at things. That's just purely from an accountant's point of view, because as an accountant, that's how I was trained. It's like, you do not want to have repairs and improvements, 30% of your top line rent one year, and then suddenly it's 90% the following year. Because then they'll ask questions. Why is it 90%? Show me. And then if it flags up something which they don't approve of in the 90%, then they go, right, let's look at the year before as well then, the 30%.
And you could go
Let's
back
look at the
6
next
years.
year before.
Yeah.
Let's look at the back year before. And then that then opens a whole can of worms. That's why it's important just to identify the stages at the right points. And, you know, that's a long way to say about critical path analysis and how that works. But that's effectively what I used to do. And I still do that today in certain situations, because you don't really want to highlight to anybody that you're not aware of how the system works, but you want to work out how it works in order to tick all the boxes before you start the journey.
Yeah. And when you talk about your tax return and doing it, I mean, that's just smart tax planning, because if you've got a lot of maintenance and things happening, you could put so much through in 1 year and carry the rest on to the next year to divvy that up, so you've not too much.
Yeah, it depends within reason, remember. Accruals and prepayments are a matter of, was the decision made to do that work in the tax year you're trying to claim it, or was that decision to do the work in the tax year after? That's what you've got to work out, and you've got to be able to answer that question. Does that make sense?
Yeah.
So, for example, Queen Margaret Drive, okay?
Yep.
So maybe it comes up to March, and the end of the tax year is obviously the end of March, and we get Queen Margaret Drive back, and then we decide that it's going to cost £25,000 to do this, okay, to do this work. And then you have to think to yourself then, okay, £25,000 to do this work. It's in this tax year. And then you think to yourself, wait a minute, it doesn't work out that well how that tax year's going, you know, how that's going to work. Now, you're perfectly within your rights to accrue for that there and then and actually set it off against your profits, because it is a cost that you're going to have to bear in that tax year. But you could decide then to actually wait till the following month and then start the work. And then you could claim it in the next tax year if that's more advantageous to you at that point in time. Accruals and prepayments. It's how the whole accountants industry works. Just smart tax planning.
Yeah, definitely. And I think when we talk about the bottleneck thing within, obviously we'll talk a lot about property today, but it is in other markets and things as well. And a lot of investors, they're probably facing quite a lot of different bottlenecks all at once, if depending on what their investments are. But you know, like things like property transactions are sometimes taking a bit longer than what they used to. Some businesses are delaying their investments, and stock markets are reaching quite highs, while the economic growth remains quite uncertain at the moment. And it has done over like recent years. So it leaves a lot of investors asking, you know, where should my money actually be going here? What should I be doing with it? And it could be quite confusing.
Okay, so let me tell you the answer to that question. The biggest risk today isn't choosing the wrong investment. It's allowing uncertainty to stop your investing altogether.
That uncertainty could hold a lot of people back.
Yeah, that's it. Today's discussion really is looking at the bottlenecks and where they exist and where the opportunities are quietly forming. So this is the classic example. Then we'll talk about this then, because we've briefly covered property anyway, and we want to talk about this anyway, because this is what people are on for. How do I create wealth out of property? It's always been one of the UK's favourite investments. It's the second most talked about thing behind the weather. It's what everybody talks about all the time. The property prices. Oh, the price of my house. I bought it at that. You know, it's worth this today. It's like, yeah, okay. And I'll be honest and say, so what? It's only worth that if you're ready to trade it in and you're ready to cash it in. It's only worth that. If you're trading it for another property, then all you're doing is trading like for like, but paying more or less depending on what that property is, because that's gone up the same value more than likely. But investment property is a different thing completely. Investment property is all about gain, but it's all about capitalizing on that gain, but not actually creating a tax charge by using that as leverage against the bank's borrowing. And this is why I'm looking at buying a block of flats with no money down,
Yeah.
complete 100% financing. And the bank, yeah, okay, we're going to do that for you. There you go. Have I created a capital gain to do that? Nope. And that is what this is all about. You have to understand how to play smart and see where that is. Yet in today's market, it does feel slower than it is for years. Why is that?
Yeah, I've heard that a few people, that sometimes it feels a bit slower than previous years. And we've got a lot of things. There's higher borrowing costs, all the regulations. That they've increased the regulations quite a lot around property, planning restrictions, and that construction costs, maintenance costs for contractors, materials. There's a lot of uncertainty around the policy for buy to let and property at the moment. Rent controls. We done a show. I forget if it was last week or the week before, but we done a whole show on rent controls. That has a lot of impact on your buy-to-let investment. And then landlords exiting as well. I mean, we've seen a lot of single unit landlords. I mean, I think, did you quoted about 70,000?
70,000 single unit landlords in Scotland left in 2019, yeah.
Yeah. And then developers and things with housing, projects are getting delayed and things. And the result of that, it begins to make supply tighten while the demand continues to grow.
Well, and look what happened in Cooper. Over 1,000 properties were meant to get built on the outskirts of Cooper, and Persimmons turned round, I think it is, and just said, "Oh, we're not doing it now." I mean, they better spend a fortune on doing all the consultancy and all the planning and all the applications and everything like that. But to walk away from that, that's quite a bold move. There must be an underlying issue there, which they think, no, we're not going to take that risk. It is too risky. And I've got a funny feeling it's the stability of the economy at this point in time. The huge borrowing costs we've got against GDP and that ratio, and it's really high in comparison. I mean, not as high as some other countries like USA and stuff like that, but you've still got to take that into account. And just because the USA is higher than us, it doesn't mean to say you should do it. Remember that when you're investing in property, just because someone else could do that deal, it doesn't mean to say you should do it. Because if they're maybe not in a position to weather a storm, or maybe they are and you aren't. They've maybe got backup from assets somewhere else.
Mm-hmm.
It does that, and you're not. You're just taking that risk and being fully exposed to that risk as a result of it.
Do you think it's fair to say you should really concentrate on the numbers for your own investment, and whether you could, like you say, risk analysis, whether you could weather a certain storms and not just look at others and think, I want that, let's do that, without really
because we've seen it all the time on things like Instagram and TikTok. It's like, I bought it for that, and then they do a wee dance, and then I got it, I paid that and refurbing it, and then they do a wee dance again, and then it came out with that, and then they do a wee dance again, and then they do that, and they go at the end, and it's like it's pathetic. It's like, it's bullshit. It's like, because that's not how it works. What happened in that equation that you saw on TikTok or Instagram or wherever it was, in that deal that you saw getting done in these numbers, what bit did it show you life got in the way?
Yeah.
Because it did. It sounds so simple, like, oh, I could do that in 30 minutes. It's like, yeah, you could do the video in 30 minutes. You'll not do the transaction in 30 minutes. And it's the blood, sweat, and tears that goes behind that no one takes account of. And the risk at the end of it, they possibly expose themselves to as a result of doing that deal. What would happen if the market dropped 20%? Oh, that won't happen. Well, it happened in the credit crunch.
Yeah.
And that was debt. It caused that problem worldwide with the banks. So you never discount a situation. You just prepare. You just plan in case. Not prepare for it, because then that's a bit overkill. But you plan in case and protect the downside. The one thing for me, when you talk about this, the bottlenecks, is housing shortages are not disappearing. Yeah. I think we are actually having one of the lowest new build house targets on record for this year. I think that's happening. It is getting extortionate to build a house with the net zero requirements. You can see it in Kinghorn.
Yeah,
the council were paying like 220,000 for a 2-bedroom flat. For every 2-bedroom flat, 220 grand to build them. What? I remember when you could build a house for that.
Yeah.
And that wasn't long ago. That was before net zero. You could do that, and all the new planning requirements are higher and higher insulation. Funny enough, it's actually turning round to bite them, because it's now getting to the point where we're getting so hot in this country that when you're inside the property, it's almost 30 degrees now, and they're too hot. So they're going to have to install air conditioning. Wait a minute, that's the most unenvironmentally friendly thing going.
But yeah, the net zero is pushed forward. There's not, like you say, extra insulation, solar panels, ground source heat pumps, and all, and it pushes the price right up.
Rental demand continues to exceed supply in many areas as well.
I mean,
look at the one in Dundee for you.
I was just going to use that as an example. We had about 100 inquiries for one house, 2-bedroom, mid-terrace, nice house, about 100 inquiries.
Standard property, just basic.
Yep, ex-local authority. I mean, done a good standard, but yeah, inundated. It's crazy.
So if they could build student accommodation in the private sector, why can they not do it just for the private sector for leasing? You know, for people for bedsits and stuff like that. Fair enough, you need houses, but all the people in the flats and stuff like that, 2-bedroom flats, it might just on their own, then possibly that's a place where they could be instead. I don't know. I don't know the answer to this, because I don't know the full demographics about what's going on in that market right now. But I do know what they're doing now, and is jack shit, and literally do nothing. And that's the problem. They're sitting on their hands. The government, they're like, oh, we'll have a discussion, we'll have a consultation. It's like, God's sake, just do something. And even if it's the wrong thing, how drastically wrong could it be from not doing anything at all? Because that's even worse.
Mm-hmm.
And yet, so they are shelling out all that money for all these properties getting built, and they seem to think the panacea is like, let's buy the existing rental stock or council houses that were sold off from private owners, and we'll use them for rental. Okay, is that not like just shuffling the deck chairs on the Titanic?
It's a good way to put it. Yeah,
it is, isn't it?
Mm-hmm.
It's because it's all you're doing is moving the stock about, and it's the same stock. All you're doing is changing the tenure on it.
Mm-hmm.
How is that going to help increase supply to curtail demand in order to level off prices for house prices and for rental? Interestingly enough, I saw a report the other day, and it's actually a factual report. As soon as they lifted rent controls, the Scottish government, last March, they went, we're not having any rent controls now, it's free fall. Rents have only gone up 1% on average in the year.
What's that?
You couldn't make that up. Rent controls, rent goes meteorically high. No rent controls, rent stabilizes, and therefore, no worry. That's crazy, eh?
Yeah.
So no rent controls works, rent controls doesn't. What does that tell them? And they'll probably still put it in.
Yeah, I'll still come at some point.
It's a vote catcher, that's all it is, and we're the whipping boy at this point in time. It's easy to kick a private landlord and get loads of votes from people, because we're only about 200 to 300,000 people in the whole of Britain, which is 6 million. We're just a minority group anyway, so they don't care. We can't do anything. We've got no control. We're all disseminated. We've not really got a unionised body. Scottish Landlord Association is fine and it gives you the right information, but there's not enough people in it in terms of private landlords in order to have any clout against the government and say, this is what we're doing.
Really push the issues, yeah.
Yeah, and that is the problem. We're disseminated. And Scotland continues to experience pressure in major rental locations. It's the cities that are driving these price rises.
Just going to say, well, Dundee's a good example at our end, but I also see it in areas like St Andrews, popular rental area. St Andrews experiences that as well.
Fewer investors creates greater opportunity for prepared investors, and I'm all for investors leading the market, because then it makes it more lucrative for me. And I will use the word lucrative and profitable, because that's the business we're in.
Yeah.
But we're also in the business of people. And that's the reason why I'm about to say that's why my rents are 35% below where they should be inflation-wise. Because I'm not here to maximise it out and push people to the limits. I am here to provide a service at a rate where my tenant is pleased and I am pleased with the return. And there's a happy medium right there. And that's why it doesn't really matter that much that I'm not hitting the full inflationary value of the rent, or somebody's getting £700 where I'm only getting 600. It's like,
That's an example I was thinking about. Yeah, the flats in Kirkcaldy.
my numbers still work. My numbers still work. That's okay. And that's okay for me. And I know I can weather a storm. I know if it rises or it decreases or whatever happens, I know I can weather that storm. So I'm okay with that for that reason. That's how you should set up your portfolio if you're building any form of property wealth.
Yeah, the mindset of some investors, not a lot of investors, is to push their rent levels to the limit, and that's not the best strategy.
See that all the time, don't we?
Yeah.
I need another 50 quid a month. Okay, it's going to take you another couple of months to get that 50 quid a month extra. And another couple of months that you're going to lose that rent, which is the best part of, 600 on average, say. So 600, it's 12. That's going to take you 2 years to get that back once you get somebody in.
Mm-hmm.
So you've lost 2 months rent, which is going to take you 2 years with a person at an extra 50 quid to get it back. And if you don't rent it by then, every month you're losing, you've got another year you're needing to let to that at that rate in order to get that money back. Why not just let it at the 600 straight away and get somebody in?
Yeah.
So that means, and here it is, that really it rewards patience for everyone that waits.
Yeah, buy-to-let investment definitely is a like you say, rewards patience game.
I had a conversation last night actually with an up-and-coming entrepreneur. He is an entrepreneur just now in the water industry, bottled water, canned water, stuff like that. Moved from the salt industry into water because that's when they realised, wait a minute, we're in the water industry because it's a lucrative business. I had a conversation with him last night, and it's quite interesting that he's not prepared to be bored. It's difficult for him. Whereas I'm like, yeah, I can wait. Boring pays well. And I think the one thing I've learned over the last 30 years in property investment is boring pays well. Don't tinker with it. Don't muck about. It's like the person that's got an investment fund. They check their share price every single day. And every single day it goes up and down all the time. It never stays the same, more or less. And the person gets frustrated as a result. So they think they should jump to something else and jump to something else. And they're paying transactional costs every single time they do that. And then they're actually losing the opportunity of the compounding interest. And if history has told us anything, the passive index fund outperforms over 95% of active investors. So active investors, people like the fund managers. A passive index fund outperforms about 90 to 95% of active fund managers. That's people that are doing the deals. So that tells me everything. The reward definitely rewards patience, and everyone that waits as a result. And you just wait for the right opportunity to come up and build wealth and store wealth as a result. Now, I don't mean chuck it under your mat or carpet. You're actually putting it somewhere else where it's probably earning, but it's ready to be utilised at the point in time when you want to reinvest it.
Yeah,
that's
put things in place, position things, and then let time do its thing.
We briefly touched on the stock market. So let's talk about Richard. I want you to talk about the bottleneck for the stock market then.
Yeah. So, the stock market bottleneck, global stocks and markets things, they continue to produce really high records. Yet confidence doesn't always match that those valuations. Mm-hmm. And investors with the stock market really tend to worry about, obviously, things like inflation, interest rates are a big factor. The global conflict, at the moment in time, that has a big effect on the stock markets. AI is causing a lot of disruption as well. government debts. We just spoke about that briefly at the beginning there, how that's having an effect even on housing, and the company valuations within stocks and things as well. So
it's interesting that AI. It's interesting that AI. Just to jump in there, and you said about AI disruption. AI disruption can sometimes be for the good, because there's a lot of inflation in AI stocks just now. But as we had looked at this before, and AI, I think, makes up 40% of the S&P 500 index, which is extremely worrying. Hence the reason why I wouldn't tend to, because you see loads and loads of blogs and vlogs just now saying S&P 500, S&P 500, S&P 500. If it makes up 40% of that market, to me, the S&P 500 is no longer a stable investment vehicle. It's like that's like
heavily on AI.
Yeah, the bubble. So it's meteoric rise from, I think it's about 120% in terms of rise in value over the last 5 years. Whereas the FTSE 100 index, which is more blue chip stocks, that's only risen about 60 to 70%, which is significantly less. And you could go, oh well, I should have been in the S&P 500. Let's get in it now. You're too late. It's at its peak, I would say, and that's just my personal view. I would rather just be in the boring old FTSE 100 index or something like that, because then I know they're blue chip stocks. It move gradually up over time. It's kind of like property. If you look at the English market, you see volatile dips and swings up and down. And over the period of time, they're a lot bigger than what they are in Scotland. And if you see the credit crunch on the Scottish one, the chart goes like that from 1980s. It goes along and it goes up and it goes. Did you see that? That's just the bit for the credit crunch, and then it continues to go up after that. Whereas if you're in England, it goes like that and it goes boop. It's like something on a heart monitor, and then it goes up from there. So yeah, there's more gains to be made, but there's more downside as well in that as well. And that's what I said. It's you don't need to dabble with it. Don't check it every day if you're in that sort of thing. Just every now and again, reevaluate what you want to invest in or your exposure to certain markets, and that's all you need to do. That's all you need to do. You don't need to get carried away, and that will be based on exactly what you said there, Richard: inflation, interest rates, global conflict, government debt, company valuations, all these different things. You could kind of get easy access. You kind of know what's going on. But I'm not promoting to be an active fund manager. I'm just promoting to know when to possibly put. You put your constant amount in every single month. That's what I would endorse. Put a constant amount in every single month into your investment fund, into your pension. Okay, because you get tax relief on it. Remember, you get tax back, which is a great boost as well. So you're not only you're getting an instant return on your money as soon as you put it in, with the money it's getting added from the tax man. So that makes absolute sense to me. And then that money is going to make money if it continues to grow up steadily over the years ahead. And that's all you need to do. So you don't need to do anything tragic. But the additional override of that is then you obviously, if you've got chunks here and there, I didn't mean like 10 and 20,000. I mean like maybe a couple of £100, maybe 500 quid here and there. You get a wee windfall on something and you think to yourself, okay, what's the market like now? Oh, all right, okay, there's a wee bit of conflict in the Middle East going on. The FTSE 100 has actually dropped maybe 1,000 points, which is about 10% of the value. Maybe it's now a right time to just put a chunk in and then get the tax back on that as well added on. And then when that recovers, because it will recover at some point in time, it gets back to normality and then it grows from there. So you've got that instant jump later on within, I did it in a couple of months with the Trump carry on when they first announced he was going to get involved. And the market dropped significantly. Then I said, get your money in. And everybody went, no. And I went, within about 2 months, there was about 15% to 20% improvement. So I got 20% hike in 2 months. And I got the tax back on it as well. Great. So these are the sort of timing things you want to look for as one-offs, but keep your steady amount going in every single time. I've got my company pension, I hear everybody saying, and that puts a steady amount in every time. Let me give you an example about what a company pension is. It's exactly where everybody else is going to be when they retire at your age as well.
You need to be doing
something. You're going to have the same standard of living. Yeah, you have to be different, because you'll just be average like everybody else, because that's what it is now, a company pension. It's just average. That's it. Because when everybody retires, they're all going to have almost about the same amount of money, because they're all on about the average wage. And so the average amount's getting put into the same sort of funds, and it's growing at the same sort of rates. So when you get out, you're going to have this influx of money. Inflation's going to pick up to absorb it, like they did it in COVID. That's what it does. When you pump money into the economy, inflation takes account, absorbs it all up, prices go up as a result, and you're exactly where you were before. I don't want to be exactly where I was before when I retired.
No, I think especially in retirement.
Yeah, I want to be a bit further forward than that. I want to be able to make choices. I don't want to have only one choice. I want to have several choices about what I would do, where I would go, what I would buy, how many nights outs I could have. I don't want to be restricted like that. So if you want a really good life later on, and everybody, you know, I hear people saying right now, and it's like, oh, but you get run over by a bus tomorrow. How many people have been run over by a bus? Out of the 66 million, 6 million in Britain. Yeah. And you think you could get run as if it's a normality.
I know.
It's like everybody every day, loads of people get run over by a bus. And it's just a saying, Jim. It's a destructive saying. It's everybody else wanting you to be exactly like them. Take a good look at that person. If you want what they've got, listen to what they're saying.
Mm-hmm.
Otherwise, don't listen to it at all and do your thing.
Yeah. All these factors as well, I mean, they create, obviously, that kind of doubt and uncertainty with investment. And a lot of investors, do you know, they'll wait and they'll hold on, do you know, for this imminent crash or just something happening. And that, do you know what history shows us that? And that waiting.
It was supposed to happen 6 years ago.
Yeah. And that waiting for, this might happen, that might happen, and waiting for the perfect time, that then becomes very expensive because you should have done it, do you know, weeks, months, years ago, instead of waiting. And like you said, Jim, the best performing markets, do you know, it doesn't frequently happen immediately. It's probably after, do you know, the worst times and things that then you see, like you said, go in when there's periods of doubt with everybody else, invest, and you'll see the returns then come later on once that passes.
Here's what you have to remember. Missing only a handful of recovery days, in other words, your investment days, can dramatically reduce your long-term results. The bottleneck isn't the market. It's the investor psychology. It's the fear it's created, and it actually delays your decision.
Yeah.
Delay creates missed opportunity. We can all look back to our history about what we didn't do and what happened as a result of that.
Great thing, yeah.
Hindsight's a great thing. If, you know, as I said, hindsight's a great thing. We could all look back and say, I wish we'd invested in AI and Nvidia. We'll all look back and, you know, the analogy about if you bought an Apple stock rather than an Apple phone, you'd be worth a fortune today rather than actually buying their phone all the time. Yeah, hindsight's a great thing. But there is a lesson there. There is a lesson there somewhere. And the lesson is invest now for the future rather than actually wait until the last minute, because compounding wealth is the best thing that ever happens.
Yeah. The advice about investing now brings us on to, I was going to talk about cash and that becoming its own bottleneck in itself. And investing nowadays is really something that you need to do, because the days of, you know, save and you'll be fine. And many people still believe that cash equals that safety because you've got savings. But cash has that invisible risk of, and it's inflation, because inflation just quietly reduces your purchasing power with cash if it's just sitting there in your savings account doing point whatever or 1% at the most interest.
Yeah. I mean, I've got Ben's clued up on that. So Ben's got quite a significant amount of cash, and he's got it in a bank. And then he comes to me the other day and goes, "I've got it in Monzo now. It's earning like 5%." And it's like, perfect. Because I know inflation's sitting about 3%. So yeah, I know inflation's sitting at 3%. So you're making 2% differential. I mean, I could recommend putting them in a bigger an amount, but I kind of think I'm comfortable with the fact that he's got cash. Because it's important for me to know that, because they're going to get all what I've got anyway. So why would they, go and buy more property, buy property, Ben? I mean, he wanted to do that. And I'm like, don't bother. We've got enough.
you're going to have all these.
How much more do we need? And then it's the comfort at the fact that there's 50, well, it is 50 grand. There's 50 grand. I shouldn't have said that. Sorry, Ben. I mean, what, 26-year-old? It's like, what? That's mental.
Yeah.
And a 6-figure pension. That's
but
crazy.
That's because you had them set up for birth for their pensions.
Yeah, I know.
Which is good. And that's what everybody needs to think about, especially if you've got kids and want to think about their future.
But it does have that. Inflation does, you're right, it does erode it. Savings accounts don't actually give you I mean, it's determined like that. That's how the world works. So if you're lucky enough, you could find a savings account that gives you a higher rate than what inflation is, then go for it if there's no major penalties on it. I mean, why would you not? What was the point of just sitting in a bank account doing nothing and just eroding away in value? And people go, but it's still £10,000. Yeah, but the £10,000 3 years from now won't be able to buy what £10,000 today can buy. You can see that in property prices. If they go up 5% every year, then the property becomes more expensive. So the property you would have bought now will be 5% times 5% times 5% on top, compounded in 3 years' time. That's the difference. So it's not, the property in 3 years' time isn't 115,000. It's the 100,000 times 0.05 times 0.05 times 0.05. Which is 115,762. So it's more. It's compounded as a result of that for that reason. So it's a bit more, but margin over 20 or 30 or 40 years, it's going to be a hell of a lot more.
Yeah, and in contrast to your money sitting in the bank, you've got things like buy-to-let housing investment and things like the assets continue to produce an income. Property continues generating that rent and cash flow. Markets continue rewarding productive capital and things. So cash has its role, of course, but holding too much of it in that one place, like a savings account, can become it's far too long, and then it becomes an investment decision itself.
Yeah, sometimes holding nothing. Yeah, as you say, it's more expensive strategy available. Yeah. It's the opportunity cost, isn't it?
Yeah.
I could have invested it in that, and it never happened. We talk about property quite a bit, but you also have index funds which are set up to pay dividends out over a period of time, and your pension's like that as well. I mean, your pension can go into an annuity, and they give you a guaranteed amount for the rest of your life, and then sometimes they can index it as well, and then sometimes they can actually pass it on to your spouse, depending on what way you want to do it. So there's all different methods you can do that. And there's another method is which I'll just take it out when I want it. I'll not do an annuity. I'll just draw it down when I want it, which is what I did.
Yeah.
At that point in time, I could still buy the annuity, but do I really want to do that? Why would I want to do that? Why would I want to have a guaranteed income, which would get in the way of my tax planning?
Yeah.
Yeah. Imagine that, eh? Upset your income will get in the way of your tax planning.
It's a good position to be in.
I'm not really sure if that's a right decision, though. But it certainly works for us just now, I would say. And having that available at the side allows you to do certain things. Like, okay, we'll just get our kitchen done. It's maybe 20 grand. It's like, okay, we've got the money to do it. No need to borrow. That's what it is. So you've got it lying about if you need it, and you can draw it out, but it's actually invested just now. So these are all different strategies you can use. This then brings us naturally and nicely onto the wealth bottleneck that nobody actually really talks about. What is that?
So when you talk about that, the greatest bottleneck that rarely appears, like in the news, financial news and things, it's the personal side. And people wait because they think they need more, more money or more knowledge. They try and time things and get better timing and have more certainty. And it's this delayed thing. It's the delaying because you're uncertain. Waiting on that promotion. I'll wait to get my next promotion and I get a wee bit more money, or I'll just wait one more year. And then another year passes. And then, and it happens to everybody. And you need to get yourself out of that mindset, because that's ultimately what will hold you back.
It happened to me in the very beginning. But I was so fortunate at an early age, in my early 20s, to have mentors that actually helped me understand this immediately. It took a wee bit of time, and it took a wee bit of reading and understanding and learning and educating myself by their system and the books and the tapes and the upline and the podcasts and all the rest of it. That's what you call it today. And the functions I went to. But eventually the penny dropped about the fact that the earlier you invest, the more it'll compound in wealth over time. And if anything has taught me, even though you're on skint row, put something aside, whatever it is, just for the future, and stick to that discipline. When we first started out, our investment strategy was £26.20 a month in an endowment. That was it. To pay off a mortgage in 25 years' time, which was 20 grand or something like that. That's what that was. That was our investment strategy. You had to have that if you were getting an interest-only mortgage. You had to have an endowment. Nowadays, they say the endowment doesn't work, and the mis-selling scandals and all the rest of it. But that was great, because when we moved and got a capital repayment, that endowment was ours to use, and I had about 4,000 in it, and I was able to use that. At that time, we're buying property for 20 grand. So that was 100% funding, because I was able to use that as collateral for the 100% funding as a deposit, because it was guaranteed to pay out 4 grand minimum. So therefore my loan to value was 80%. So the bank went, okay, we're doing 80% deals. We're fine with that.
Yeah. That's a really good example of how you could start without having a vast amount of money behind you. Obviously those figures are a lot different for nowadays, but you could, you could still compare it to,
if you compared it to a percentage of your salary, at that point in time, I think I was earning 9 grand a year. Okay. So 9,000 a year, I was probably coming out with about 7. So 7 divided by 12 is 583. 26.2 divided by 583 is, about 5% of my income. So 5% of my income went into that fund.
Yeah, that's good.
And then what happened is we decided to get a versatile investment plan and just put 40 quid in as well, over and above that. So we're putting £66.20 in every single month. So 40 quid went into a versatile investment plan for, I think it was a 10-year plan. And again, that it compounded a wee bit, and then it got to about £4,000. And guess what? Guess what I did? Used it as collateral to get 100% funding again, because I proved the last time to the bank that it works, and they went, "You're damn right, it works. We can see the numbers coming through just on one unit." And then I showed them the example about compounding this up to several units, and they went, "Oh yeah, boy, that flipping heck, we never really thought about that. That looks good." And could I have been the master of the buy-to-let mortgage and why it popped up?
Yeah, at that time, you were definitely a part of how that all come together.
Could the banks have then gone, wait a minute, this guy's doing this way all the time. We should have a product for this, because this is a popular thing. Maybe that's one of the times that, without knowing it, you actually influenced what was to come, was the buy-to-let mortgage. Because I used to go to these things with the Bank of Scotland, and they used to go, God, you're doing exactly the right thing. It's like, I can't believe that. And then the product appears, and then everybody starts to do it. So maybe not. I'd probably think maybe not, but I like to think it maybe.
You like to think, yes. You had some involvement in that. Yeah, definitely. But yeah,
it's the reason that people are waiting, and the reason that I was disciplining myself to do it was you could always have more money. And that's what, and more knowledge, better time, and more certainty, and that's what they wanted. I mean, I know people that have they went out of their way to get more knowledge, and they've never done anything to date. Never done anything to date. They saw everything I saw in the beginning, because I've spoken to them about it. They went to the places that I went to in the beginning, which no longer exist. Russ Whitney from America, which was a system which is like a selling system for courses. And that's the type of things I went to in the beginning, but I never paid for them. I just went to the introduction days, got the information, went, oh, that's good. I'll add it to my knowledge bank for free. That's all it is. And that's what helped me get started. So that's what people end up, paralysis analysis. Some people are just locked into that. It's always about, you said it there about, I'll just wait till I get another promotion and then I'll put money aside. It's no, you'll know. You'll end up buying a bigger house or a flashier car. Or you'll have 2 cars instead of 1 car. That's what will happen. You'll end up installing a new kitchen and putting it on finance or something like that. You'll end up putting a new bathroom and put it on finance. That's what happens when you do that, when you get more money. If you're not in that savers mindset, or investors, not savers, investors mindset. Another year passes. People that are successful investors rarely wait for timing. Rarely wait. They just get on and do it and invest. And then
there's never that big time.
Yeah, the start is, and then people, oh, you're okay. You got in at the bottom floor. It's like, well, the bottom floor is now. If you get in now, that is the bottom floor. Because in 30 years' time or 20 years' time, somebody will go to you. You're okay. You got into the bottom floor. Yeah, I could say that about Andrew Carnegie. You're okay. You got into the bottom floor in the 1930s, the steel industry. That's why you became a multi-millionaire, 300 million net worth, which is equivalent to a billionaire today. But do I? I
think it's important to remember that everybody's journey is going to be different, and it's never going to be exactly the same.
You play the hand you're dealt, and you play it to the best of your ability. That's all you can do. If you're lying on your deathbed and you've got a regret, you better do it now then. That's my motto. If you've got a regret when you're lying on your deathbed about what you're maybe thinking about now and you don't do it, you're going to regret it. And I don't want regrets.
I was going to say, if you get hit with that once tomorrow.
I want to go in. I want to slide into my grave, more or less. And it's like, I completely used up, worn out, made the best of everything, took every opportunity and did it. Some have failed, and some have failed, miserably,
But
and some tried. Yeah, some have succeeded, but at least I was the person in the arena fighting it out and making it happen. While everybody else was watching it happen. Some did wonder what the heck happened.
Yeah. And it's just things like simply just start earlier before everybody else does. Your actions, I think, then they grow your knowledge. People try and get the knowledge and then do the actions, which is obviously, but sometimes if you just put things into action, you learn a lot more.
Done is better than perfect.
Yeah.
That's exactly what it is. Just do it. There's a motto there somewhere. Will I coin that phrase? Oh, somebody's got it already.
Yeah, that's already taken. Yeah.
But confidence does grow by experience, doesn't it? Momentum grows through consistency. And it's consistency that will take you through. Right, okay, so let's then go into this subject. Where opportunity is starting to flow. Every bottleneck eventually breaks. When it does, capital moves quickly. Yep. There's opportunity there. We'll talk about something really controversial right now. PPE.
Yeah.
Look at the amount of money, irrespective of, some people took advantage of this and, for want of a better phrase, conned the governments. But look at the opportunities that people took. Look at Dyson, how they pivoted to PPE. They did that straight. Dyson went, your opportunity, definitely, because nobody's going to buy Hoovers because they're in their house all the time. They're not allowed to go out. So what do we do now? We're out of business. How do we keep the workforce active? PPE. Let's do that. So see how that was. The people acted quickly. Yeah, took that opportunity. They made it work, and that's what made the difference to them. Talk about, property area. What would we discuss on property if we were going to look at that? The opportunity, where it would start to flow.
Yeah, opportunity when it starts to flow with property. It's areas and regions where there's undervalued regions. markets where you've got undervalued, and here in Fife, like Glenorthis is still very undervalued.
Undervalued, Leaving still undervalued as far as I'm concerned. Yeah. The areas like Methil and that, and there's some people who go, Methil, oh, you didn't want to go there. It's like, God almighty, if you could see some of the areas in Methil are really nice in comparison, and it's like and the price point, wow, for what you're getting, master back gardens with double bedrooms and everything like that. Yeah. I mean, that just, a rising tide lifts all ships, and it's got to start somewhere. Imagine when Battersea in London, Battersea power station and everything, when it was all there, and somebody said, oh, I think I'm going to stay in Battersea, and they're going, you're having a laugh, next to the power station. Away you go. And then look at Battersea now. It's literally an upmarket area as a result. Do you think the people that got in at the beginning regret getting in? No.
Yeah. It's the most affluent and trendy area.
You have to see that opportunity somewhere. You have to see that. Look at the advantage I had in Aberhill. It's 30 years, actually, I've been in that area. And now it's right next door to the train station. What do you think that does to a real estate market when it's next door to a train station, literally within 200 or 300 yards? Walk down the hill, get on the train, and you're in the city centre of Edinburgh within just over an hour. What do you think that does for real estate?
Pushes up.
I knew that was going to happen at some point in time. I was surprised when it happened, but I just had this at the back of my mind. Yeah, this is going to happen at some point in time in the future, because everybody wanted it to happen. It was just a matter of timing. And I would never have got that right, by the way, if I'd actually waited to see when that happened. If I jumped in when it was announced, I'd be paying top dollar for all these properties now. But I jumped in when it was on its knees and was buying them at £9,000 and £10,000 and £15,000 for 1 and 2 bedroom flats, and 3 bedroom as well.
Having that mindset to kind of forecast into the future. I mean, it's inevitable somewhere that close to the centre of a place like Leamouth. Something's going to come over time in that area.
Every market's like that. As long as you can play down the risk, okay, of that in that situation when you move into a market like that, and you've not got huge periods of voids. I mean, there was 1 year where we actually had 2 or 3 properties that had a year's void. And it's like, what? This is mental. But we could weather a storm because the return on investment was there. So it was just all about servicing the debt and making sure that everything was looked after and the repairs and improvements were done. And that was it. And never actually relying on the income to live day to day. Still working a job of some sort and actually not taking anything out. That's the key. I mean, how many people put into a pension and actually still take money out of the pension while they're putting into it? No one. So why would you do that with your property investment then?
Yeah,
doesn't make sense, does it? Yeah. No, it doesn't make sense. But people actually think that the property is going to make them an income, when in actual fact, no, you've got to treat it like a pension for the future. It's another strategy towards your investment. Now, remember, we are only giving our opinion. This is not financial advice. You should seek financial advice from a properly qualified person. So this is just an opinion, but this is what I've experienced over the years personally myself as a result, and understood how the market works and the mentality behind it. Oh, I should make as much out of my property as out of my investment and my pension. And I'm like, okay, well, you're taking money out of the property every single month and you're living on it. So that's not going to make you anything. You're not doing that with your pension. And with your pension, you're getting the tax added back as well to boost it. And you're getting the return on investment on the tax as well as your contribution. And you're not taking any money out of it. And it's compounding over a longer period of time. Why are you not doing that with your property then, if that's the case? So you can't compare. You're comparing apples with plums or whatever, bananas, whatever you want to choose. That's the difference with that. Undervalued regional markets, you've definitely hit the nail on the head there. Long-term rental demand has got to be considered. Value-add opportunities. Is this a rundown property? How much is it going to cost me to refurb it? What's it going to be realistically worth at the end? Not what somebody's going to put on it just because to make you feel happy and do a TikTok dance.
A realistic valuation.
That's no what you should be looking at. The refurbishment projects, what you need to do, commercial to residential conversions. You know,
I was just
I
going. I
know a
was.
local contractor, a local person that works all the time, and all he does is over the years he just buys up the wee shops that are going out of business, that are no needed anymore, and converts them into 1 and 2 bedroom flats.
I was going to ask you about that, how, because there's a few investors that I'm speaking to at the moment, and this is what they're looking at, and they look to obviously purchase the commercial. They're trying to obviously get away from stamp duty and things as well, and then do the conversions. What's your take on that, Jim? Do you think it's a good strategy?
If that's your thing and it works for you, then good luck to you. I do not do that because I've got no experience of getting planning. I've got no experience of understanding how the project would work. I've got no desire to learn how to lay out a property and make it look beautiful inside. It's like I just know a number and I just know numbers and I just understand if I buy it for that and it costs me that to refurb it, or I don't need to refurb it, it costs me that to finance it, it's going to cost me that on ongoing costs, and there's my return on investment. Yeah, job done. Makes sense.
That was my advice. My advice to the investor who was thinking about this, he's qualified as an architect. So I thought, look, you know what to do here. So then if you want to do that, that's fine.
Sometimes that could hold them back because they are qualified as an architect.
Too much detail?
Well, too much. It's got to be done like this.
To stuck with it. Yeah.
Because that's how they've been trained. It has to be done like this. It must be done like that. We've got to spend a higher cost on this. We've got to do this and we've got to do that because that's how they've been trained. Whereas somebody like me comes in and goes, what's the numbers? What do I need to do? Almost bare minimum to get that done. Yeah, that makes sense. Will that last long term, doing that conversion? Yeah, that would be fine. Will I be able to upgrade it later on as a result of doing that conversion if EPCs have to be upgraded? Yeah, you can. Okay, let's do it like that just now. That's the sort of thing you would have to understand. And you know, income producing assets, the income is not for you. It should be reinvested back in to either the asset or for a rainy day when you have a void or you have to weather a storm. That's what it should be there for. Just like an investment fund and a pension, definitely. This brings us nicely into pensions. I don't always invest in property. I've got an index fund. It runs with Standard Life, just to let everybody know there are other available ones there. UK Equities Fund for me, kids are in it as well, and we've invested all the time and invest regularly as a result of that. And just we're not bothered about when it's up, when it's down. When it's down, yeah, I'll take a bigger amount and put it in. But it grows over time and outstrips inflation. And I'll be getting tax back on it as well from the government. Why would I not do that? It's free money.
Yeah.
Free money. If I said I would give you free money to invest for your future, what would you say? Yeah, give me it. Yeah. As soon as I say, but you've got to put something in with it. Oh, well, that's a different story. Everybody's hands up for free stuff, but nobody's hand goes up for actually paying for the free stuff.
Put in, yeah.
So dividend paying companies is actually one where the opportunities start to flow, definitely. Global index funds, depends what you're actually. America's no great now, I don't think. Technology and AI, I think we're at the top of that. It could go on for a wee bit longer, and I'll go, I told you so. And it's like, well, but look at crypto. Well, crypto was up at 120, it's probably down at 60, 50, whatever. Somebody could tell me the answer to that. So it's now halved again. So it's like, I told you so when you're up at 120. Like, no, I told you so. I wouldn't predict it was going to drop, but I wasn't going to take a punt in a volatile market, which with something that's just not really tangible that you can't do anything with. Healthcare is a good one. Healthcare is a really good one because that's where the future is in healthcare. Because everybody wants to live longer, everybody wants to be healthier.
Pharmaceutical.
Everybody's becoming more conscious of their health. I've got a blood test coming from Newman to do my blood test again, do every 6 months, send it away to them. They determine all the LDH and DHL or whatever it is for your heart and your cholesterol, your testosterone level, your B12 level, all the rest of it, and all these different things that you get in these tests just to make sure. So see how that private market's growing as a result because we're all becoming health conscious.
Yeah.
Imagine that. People sit and say they've not got enough today. But yet, did you know anybody that went and sent in the post for a £75 health test and sent it away to get all their information, and they would have to visit the NHS for it.
And
NHS would never do that for you. They would only do it if you're extremely ill. Nowadays, that's available to you for that price, or just going to the NHS and getting it for your doctor. PSA tests as well for prostate. It's easily available now.
Yeah.
You never had that before. That's why healthcare is a really good one, possibly to consider. But again, it might just be a fund you're investing in. Infrastructure, a low-cost index fund, by the way, because the cost is actually what eats away at your profit over time. Renewable energies, not really sure about that. I'm not convinced that that's the way forward yet. Defence and cybersecurity, yeah, probably always need that. There's always a fear in building defence, and you can see them ploughing money into now. I've got a funny feeling there's lobbyists in the backgrounds for the defence industries actually influencing the governments to actually increase their budgets for defence. I think that's what it's all about. And then everybody has to follow suit and do the same. So the objective of this isn't predicting what's going to happen tomorrow. It's positioning yourself for the next decade or the next 2 decades, or for your pension in the future. Maybe if you've got 30, 40 years. I'm saying 30, 40 years, but you'd have to be about 10 to do that. And somebody won't 10-year-old.
For the next 10, 20 years, I think, is a good...
But your parents will understand it, and they'll know what to do for you for the future. If they're smart enough to do it, because you'll know have a pension if you're so young just now. So your parents will need to do something for you now, so you will actually be secure for your future. Don't rely on the government to do it, by the way. Wealth usually rewards consistency more than prediction. It does, definitely. Yeah. Okay, closing remarks, Richard, because we've overrun a wee bit.
Yeah, I mean, as you said, Jim, bottlenecks, they never last forever. And I think we've demonstrated that change, these happen throughout all the generations, but every generation believes that its challenges are unique. But history tells us a different story. You know, markets will slow, but the market will recover. Governments will change. You know, interest rates will rise, they'll fall. Technology evolves. You know, we're doing the AI thing at the moment. Opportunities move. But the question should never be, you know, will there be another opportunity? There always will be. The real question from today is, will you be prepared when the bottleneck finally clears and opens up? You know, so investors who build lasting wealth aren't necessarily always the smartest. And we say that all the time. They're the ones who continue to invest while others remain stuck, waiting, because every bottleneck eventually opens. And when it does, the capital flows, and those who are already in that position are the ones that's going to benefit.
Yeah. The bottleneck isn't the market here. It isn't property either. It isn't stocks. More often than not, the bottleneck is the delay between knowing what should be done and actually doing it.
Yeah.
Done is better than perfect.
I knew you were going to follow it with that, and it's so true. Yeah. Yeah, well, I feel like that's a really good place to end today, and hopefully we've went through how the bottleneck theory it spans across all different markets, all different generations, but there's opportunity always there. You just need to take action. So we'll leave it there today. Thanks for all that input, Jim. I think it's quite good, not to make you feel old, but you've got experience through the last 3 decades of investment in property and markets, and it's really good to get that experience firsthand and demonstrate how things do change, but they kind of go for full circle. So yeah, opportunity is there. Take action on that, and we'll leave that today. That was the bottleneck. Hopefully that's given some great insight to people who are listening. Any comments, jump in the comments box. You can reach out to me direct, and Jim and I will catch you on the next show.
I'm sure people on TikTok will have something to say.
Well, we could see.
I'll have a great laugh at TikTok.
Yeah, TikTok's...
Bye for now then.
TikTok's a hybrid of its own. Right, okay, thanks, Jim. Thanks, everybody, for tuning in. See you later.